Good morning, everyone. Actually, I should say good morning to everyone in North and South America, and good afternoon and good evening to everybody else around the world who's joining us. We're very happy to have you. My name is Patricia Mosser. I am the director of the MPA Program in Economic Policy Management at Columbia SIPA. I also direct the school's initiative on central banking and financial policy. Welcome to this webinar series. This webinar today is actually part of a series, Central Banking in the COVID-19 era that is organized by Professor Takatoshi Ito and myself. We'll be running a series of webinars during the fall semester on this topic. Today's, of course, on regulation and macroprudential policies and the lessons that have been learned. But future sessions will include the particular challenges for emerging market central banks, a session on implications for central bank independence of some of the central bank's very extraordinary actions over the course of the last 6 months, international lender of last resort, and global liquidity, which we'll talk about probably in October, and perhaps one or two others. So we look forward to the whole series, and please stay tuned for invitations to those as well. I'm really excited about this morning's panel. The three folks who are talking are absolutely outstanding experts in regulation and macroprudential policy. They have deep experience in both practice and in research on this topic. I'm going to be brief with the introductions so we can get to the heart of the matter. So let me get to that. The very first speaker will be, excuse me, Ryozo Himino, who is commissioner of the Japanese Financial Services Agency. He became commissioner just this summer, but he has a long history and distinguished career at the JFSA. He has particularly spent a lot of time on international standard settings and cooperation and regulation and macroprudential policy. In fact, he chairs the Financial Stability Board's Standing Committee on Supervision and Regulation, Cooperation. He's previously was Secretary General of the Basel Committee, and we're very pleased that he's able to join us and so late in the evening from Tokyo. The second speaker is Don Cohn. Don is the Robert V. Roosa Chair in International Economics at the Brookings Institution. He also has served for the last quite a few years, at least 8, I'm guessing, as an external member of the Financial Policy Committee at the Bank of England. But that's just the last few years. Don has a very long and distinguished career as a central banker at the Federal Reserve, culminating in being the vice chair of the Fed from 2002 to 2010, including obviously during the last financial crisis. He's an expert on monetary policy as well as macroprudential policies, so I'm very much looking forward to what he has to say. Last and certainly not least is Jeremy Stein. Jeremy is the Moise Safra Professor of Economics and the chair of the Economics Department at Harvard University. Jeremy's research for a long, long time has sat at the intersection of macroeconomics and finance. He's written extensively on regulatory topics, macroprudential topics, and the relationship between financial regulation and the real economy. And he's got plenty of policy experience as well. He was a senior advisor in the Obama administration and a governor of the Federal Reserve from 2012 to 2014. So without further ado, let me hand it over to Ryozo. And I think our speakers will talk for, I don't know, 7 or 8 minutes, and then we'll start with the questions. Ryozo, the floor is yours.
Okay, thank you, Trish. I'd like to argue for the need to look through various phases of the pandemic cycle and take into account intertemporal trade-offs in making policy choices. I have prepared a one-page slide, and let me show it to you. I think there can be 6 phases in the cycle. We have overcome the operational challenges arising from lockdown reasonably well so far, and the massive central bank interventions stabilized the March liquidity panic as well. These are what we have seen so far, and we do not know what will follow. But many anticipate a solvency phase to follow. Borrower insolvency can impair bank solvency. After the solvency phase, we hope a strong recovery phase will follow, but we should be mindful of the possibility of a confidence phase, a crisis of confidence as well. And the recovery will not just result in a return to the pre-COVID normalcy. We will observe a transformation in the economy and the society, and we hope the transformation will be the engine for the new growth. What I would like to argue is that what we do in one phase will affect what we will see in the ensuing phases. Let me cite a simpler example. We overcame the operational challenges by working from home, but this means we need to be more attentive to cybersecurity going forward. Prudential policy should also look through the cycle. We can prohibit banks to pay dividends during the liquidity phase, but that may reduce the buffer, liquidity phase, but that may make it more difficult for banks to raise capital in the market during the ensuing phases. We can encourage a bank to use the capital buffers to extend credit during the liquidity phase, but that may reduce the buffer which can absorb credit losses during the solvency phase. We do not know the maximum loss amount in advance. I think regulators can encourage a bank to use buffers only if they are prepared to resort to public support if needed to withstand the confidence phase. In this regard, I would welcome the Financial Stability Board's June report on too big to fail reforms, which stated, I quote, the resolution regime reforms give authorities more options for dealing with banks in distress, though which options are used is for individual authorities to consider in light of the particular circumstances. In addition, we should already start thinking about the recovery phase and the post-COVID growth phase. The priority during the liquidity phase is securing bridge financing to the corporate sectors and to prevent bankruptcies resulting from cash shortage. When we do not know which company will be affected, how much and how long, we cannot distinguish between viable and non-viable firms. But as we know more about the pandemic and its effects, banks and borrowers can start thinking about how to meet the challenges of the post-COVID era. If borrowers start addressing the challenges earlier, they will be less haunted by debt overhang. The recovery and the post-COVID growth will then be stronger. We do not want to see tightened lending standard now, but would like to see banks encouraging borrowers to design post-COVID business models as early as possible. As we move from the solvency phase to the recovery phase, policymakers will start thinking about exit from emergency measures. We should be mindful of the risk of taking strong medicine for too long, but we should also be careful about the cliff arising from the cumulative effects of the unwindings of multiple measures. Coordination among relevant authorities would be as critical in the exit as in the entry. We may also want to think about broader governance issues. During a crisis, policymakers are tempted to micromanage banking business. But we have intentionally designed the financial system to be composed of regulated private firms, not by state-owned banks. we should be sensitive to the longer-term consequences of shifting too much toward a command and control model. I have cited only a few examples of many intertemporal issues that we face. Policymakers tend to address issues of a specific phase one by one, but we should try to be as holistic as possible, looking through the various phases of the pandemic cycle. Let me stop here. Thank you, Trish.
Well, thank you, Trish, for inviting me to to participate in this seminar. I completely agree with everything Ryozo just said. So the question you posed was, what was the efficacy of the adjustments to regulations that were put in place during the COVID adjustment, the financial systems adjustment to COVID? Is it encouraged? How is it encouraging lending to non-financial businesses and households? And I think consistent with what we just what we just heard, my answer is it's too soon to know. We will be going through several phases, and that solvency phase is ahead of us, or we're on the cusp of that. And that's when we'll know how well we're doing. What we do know is that there was a huge surge in business lending, and I'll talk both about the US and the UK here. And both the US and UK banks was demand driven and government driven. So the banks did meet a lot of the needs of non-financial companies here who were taking down lines of credit. And they also met the needs of small businesses, but those were guaranteed by the government in a bounce back scheme in the UK and in the PPP scheme here in the US. And I think the ease with which that was done wasn't a function of any changes that were made in regulation today or over the last few months. It was a function of the changes in regulation since the global financial crisis that forced the banks to build capital ahead of time. So I think we are in the process of realizing the benefits from the steps that were taken post 2008, 2009. But we also know not only was there a big increase in lending in the US and in the UK, but particularly in the US, there was quite a tightening of credit terms. If you look at the senior loan officer survey, it's across the board for mortgages, commercial real estate, business loans, tightening of terms and conditions of loans by banks, tightening of the nature that was close to the proportion of banks tightening during the global financial crisis. I was surprised by how widespread and how severe this was. In the UK, the picture is a little different. Their mortgage credit, some consumer credit tightening, but the banks don't report the same tightening in C&I and business lending. But that may be partly timing of the questionnaire, wording of the questionnaire, et cetera. But it's a slightly different picture over there. I think a question that I ask myself looking at those results is how much of this is appropriate. So genuinely going through the stages that we just heard about, businesses are going to be riskier. There will be a shifting of resources and demand among businesses in the post-COVID era. So it's absolutely appropriate for banks to look hard at that and make judgments about which borrowers are going to be able to repay loans they make. I think our problem is that there's an externality here. There's a collective action problem. If every bank looks individually at its borrowers and assumes other banks are doing the same thing and tightens up, you're going to have too much tightening. And the banks themselves, by tightening credit, will put GDP on a lower path. So some tightening is appropriate. I do worry that there's too much tightening going on, but it's really hard. I've been racking my brain trying to figure out how to get this externality into the market. appropriately. So what we've done in the UK to try to minimize the externality is a couple of things. One, we released the countercyclical capital buffer. So for UK banks, that was on its way to 2% in normal times in standard risk environments. We'd already announced an increase from 1 to 1.5, and we were going to go all the way to 2 eventually. But we released that. It's down to 0, and so did just about every other country in the world. I saw a data, I think, from the BIS that said globally there were about 73 billion of countercyclical capital buffers in place, and now all 64 of those have been released. I think that's the first and most appropriate response. The good thing about releasing a countercyclical capital buffer is that capital can be used without incurring any distribution restrictions on the banks. It's there for them to use. It's a very clear, transparent, straightforward approach to the issue. It sends a very clear signal to the banks, whereas fiddling around with regulations around the edges, trying to undo some unwanted restrictions is not very transparent and less effective. So the countercyclical capital buffer was one thing. The second thing is we had the banks conserve capital by stopping their dividends. And we stopped them across the board to avoid stigma on just stopping on weak ones. And we told them to restrict their bonuses. We have repeatedly said that all buffers are usable. Now, this is interaction interesting with Ryozo's comments. I think we've backed that up by looking at our stress test results from previous years and doing what we call a reverse stress test. So how bad would the losses have to be to run through all the buffers? And we found in August that the recession would have to be twice as bad as the Monetary Policy Committee's forecast in order to get just back to where the stress test from 2019 got the banks, and that was okay. So we've tried to do some stress testing to test the usability of buffers. And we have discussed the collective action problem. The governor of the Bank of England has repeatedly urged the banks to keep this in mind, that if they all tighten up, everyone will be worse off. I think for the banks, we have a structure post-global financial crisis to deal with the potential amplifications. This structure may need adjusting. I think in the US, it needs implementing in the countercyclical capital buffer. I think the harder issues for regulation are going to be in the non-bank securities market areas. And we saw in March, the disruptive thing that happened in March was in the securities markets, the so-called dash for cash, which disrupted some very safe markets like Treasury securities in the US, repo in the US. These had to be addressed by the central bank, by central bank intermediation across a broad array of markets using emergency, regular open market operations, but also emergency types of operations. Let me talk a little bit about Treasury and Repo. I think Jeremy will talk about some of the other markets. What happened in the Treasury market? There were a lot of very highly leveraged players who faced sharp increases in margin calls as prices moved against them. And to get cash, they had trouble turning to repo markets because the dealers in repo, and particularly the money funds themselves, were facing a run. So the sources of repo financing were drying up, and the dealers themselves felt they had limited ability to take the Treasury securities onto their books. So you had this sharp increase in interest rates on Treasury securities, exactly the opposite of what you would expect to see in a crisis. So I think the the central banks, the Fed had to step in and take a lot of steps. I'm concerned that this will leave an imprint on risk-taking over time. I think there are a lot of questions and not many answers here. Could the margins have been less pro-cyclical while still protecting the central counterparties? Is there any way of limiting the leverage of non-banks and controlling their liquidity, how they use liquidity? Is there a way of increasing dealer capacity to make markets without compromising financial stability? And some of the suggestions in this realm have been in the plumbing. So central clearing of Treasury, central clearing of repo. So I think the Financial Stability Board has a major project on this. I think this is the big unanswered area after the crisis. Stop here.
Sorry about that. Thanks, Don, and thanks, Trish, and everybody for including me in this session. So I thought I would, as Don sort of previewed, I thought I would try to talk about one aspect of the non-bank credit provision mechanism, in particular the growing role of open-end bond funds and ETFs, exchange-traded funds, in the corporate bond and leveraged loan market. So as people know, these funds have grown really quite dramatically in importance since the global financial crisis. And I suppose that's what you might expect if you regulate the banks more tightly, impose higher capital and all that. You would expect some migration of credit provision to go outside the banking system. So, basic question is, are these open-end vehicles a systemic concern? And if so, what might be done? And my basic view, is I think they're potentially quite a worrisome issue. And, in fact, a number of policymakers, academics, other observers have been expressing these concerns for several years now. And at least in my view, I feel like events in March more or less validated a lot of the concerns that had been raised. So first, just a sort of simple caricature, to be a little unsophisticated. Think about an open-end bond fund or a loan fund. It's basically an entity that holds relatively illiquid credit assets on the left-hand side of the balance sheet and tells investors they can take their money out on a daily basis. What could possibly go wrong with that? Who knows what will or will not happen? But obviously, if something does go really wrong with this, I think we'll look back on it in retrospect and say, oh yeah. Credit assets, daily redemption kind of looks like a bank without deposit insurance. So, the potential at least is there. Now, of course, that's way too simple. As I said, that's a caricature. And there's obviously sort of some counterpoints, both conceptual and empirical. So let me sort of take those on. An advocate for the industry might say, look, the system survived a big shock. The flows were ultimately manageable. The redemptions were ultimately met, even in high yield. Now, of course, that understates, I think, the extent to which we dodged a bullet. And, Don mentioned this, because of really unprecedentedly fast and aggressive Fed intervention. I mean, anybody who was sort of talking to people in markets in March knows there was a very scary period where the outflows were really building very fast, and it looked like there was sort of the beginnings of a real spiral. Just to give you a sense of the magnitudes, this is from a paper by Filato and co-authors. The average bond fund had outflows on the order of 9% of assets under management over the period February to March. In dollars, that's over $300 billion in March alone. You should think of this as like roughly an 8 sigma event, bigger than anything we've seen. As I said, 9% of AUM. The next largest episode, the taper tantrum, which we thought was sort of a big deal, was roughly 2% of AUM in terms of outflows. Okay, so in the wake of this very, very large and building run of money out of the sector, the Fed announces the primary market and secondary market credit facilities March 23rd. On April 9th, they expand the programs. And you see sort of an immediate stemming of the problem. You know, credit spreads, which had spiked, start coming back. Outflows, which again had been dramatic, start to reverse, and you start to see inflows, especially in high yield. So it's very clear that the Fed turned the tide. And, you know, thankfully, I guess if you're an empiricist, you might be a little disappointed that we didn't get to run the full experiment. And I suspect, you know, we don't know, that it would have gotten very ugly. And moreover, I think, you know, we were, I hate to say lucky, but we were lucky in one sense. I think the Fed's ability to intervene this quickly and this aggressively was in part because, you know, this time we were facing an alien invasion. Really, this is sort of an exogenous shock. It wasn't that, you know, sort of internal to the financial system where some of the moral hazard issues and political economy issues loom larger, and it might have been harder for them to be quite as decisive. So I don't think, both for that reason and for moral hazard reasons, you want to count on the Fed being the one who backstops this market going forward. So a couple of issues. One, sort of conceptually, is this all systemic risk? You know, you sometimes hear people say, well, you know, these are adult investors. They know that they're not bank depositors. They know that their money is at risk. And so why are we so worried about protecting a set of equity investors? You know, this is life in the big city of capitalism. Now, of course, as a policymaker, you're not worried about the investors per se. That's not your concern. The concern, of course, is if you get a dramatic fire sale from these funds, credit spreads spike, and of course, those spreads become the hurdle rate effectively for lending in those markets, and to some extent, there'll be some arbitrage, so they'll become the hurdle rate for lending by banks, and you get a credit crunch. And the concern, of course, is that no individual fund, when they design their terms, internalizes the fire sale risk that this creates for the system. So in the same way that we're concerned about bank credit crunches, we can certainly be concerned about market credit crunches, and that's systemic in every sense of the word, even though you don't necessarily see large institutions tipping over. Second conceptual question, I think this is actually important, is what exactly is the economic mechanism that leads to these big outflows? And I think you actually need to be somewhat precise on the mechanism in order to think about policy remedies. So one answer, and this is sort of a classic bank run type of story, is that in these funds, because of the illiquidity of the assets, there ends up being something of a first mover advantage if you get out quickly. So specifically, if you think that when there's a big outflow from a fund, they have a cash buffer, and the first few people that exit, they basically draw down on the cash buffer. They don't sell a lot of bonds, so their net asset value has not yet been fully impacted, right? Then the people who are getting out are in some sense getting out on better terms. Or econometrically, what you will see is that in high yield funds, big outflows today forecast future declines in net asset value. In other words, the net asset value ends up being kind of too sluggish. And so again, that means that if you get out early, you will do better than those who wait and get out later. So that has sort of is reminiscent of the kind of classic bank run thing where there's a strategic reason. So if Don and I are basically sitting in a bond fund together, if I can get out before Don, I will do better, and there's sort of a subsidy. If that is your understanding of what goes wrong, then the fix is relatively clear. You want so that when I get out ahead of Don, I basically internalize the subsidy that I'm taking from him. That's what leads people to call for something like swing pricing, where we can adjust the NAV to basically incorporate the future price pressure that we're going to see as a result of my exit. Okay, so that's a sort of clear problem, and I think sort of a relatively clear solution. There is swing pricing in some jurisdictions. You might want to basically have it more broadly. I think this is clearly part of the problem, and you can see some sort of nice micro evidence that there are these first mover advantages. So I think this is clearly part of it. I think you would go too far to say this is the whole thing. A somewhat more blunter story at some level is that people panic, as they do in financial markets. And when prices move dramatically, there are a set of players who are essentially, because of behavioral factors or institutional factors or stop loss limits or what have you, are positive feedback in nature. So prices fall, they basically leave. In other words, now Don is leaving or I'm leaving in this example, not because Don is there, but just because like I'm freaking out all on my own. And then of course that propagates as well, because as many people leave, the prices move further, and it's a sort of standard positive feedback mechanism. So I think it's important to try to at least think about which of these mechanisms is playing some role. I suspect at least there's some of the latter, and one kind of clean test of that is to look not only at bond funds, but exchange traded funds. Because a nice feature of exchange traded funds, because the price can deviate below the net asset value, is that in some sense, they force the internalization of this first mover advantage. In other words, in an ETF, there is no first mover advantage, because if I rush for the exit, what do? I push the price against me, and I, in some sense, am forced to eat my own price pressure. So if you thought that runs of the classic sense were the only problem, you would quite like ETFs as a design. And in fact, you saw this. They, in some sense, have an endogenous swing pricing, because when there's a lot of pressure, the price of the ETF declines, which should be all else equal, declines relative to the net asset value, which should all else equal deter me from withdrawing. But yet, as we saw during this episode, there were also very large net outflows from ETFs. So even with this mechanism in place, there still seems to be some of the same basic positive feedback. So I think if you think that's the case, you probably think that swing pricing, while certainly a step in the right direction, may not be sufficient. And we've got a sort of more fundamental problem with the sort of open-end structure across from relatively illiquid assets. So I don't know exactly what the solution is. And again, I think we dodged a bullet here. And I hope that the fact that we dodged it won't mean that it doesn't get the policy attention that I think it deserves going forward. So I'll stop there.
Thank you, Jeremy. So now we're going to move on to the question and answer part. Our discussant is Takatoshi Ito, who's a professor of international and public affairs at SIPA, and also the director of the program on public pensions and sovereign funds at the Center for the Japanese Economy and Business at Columbia Business School. For everyone else, please feel free, if you have a question to submit, to use the Q&A button at the bottom of your Zoom screen and send in a question. We'll collate a few of those and hopefully get to at least some of them, probably not all of them, full disclosure, before our time is up today. But in the meantime, Taka, the floor is yours.
Thank you, Trish. So I have two questions. And so let me ask the first question, which is the impact of unconventional monetary policy, low for long, is how that is causing any problem for financial stability. And some observers and policymakers worry about the profitability of the commercial banks has been very subdued because of flattened yield curve and impossibility of imposing negative interest rate on retail depositors. And COVID-19 crisis will surely increase non-performing loans on the banks. So banks are really squeezed. And but the others worry that lots of liquidity due to the crisis management is causing a financial bubble in the stock market, and which is somehow disconnected from the real economy. And so they worry about this bubble to burst in the future, probably at the time of the exit. And those worry about bubble usually comes from BIS. And yet, so combining those, maybe low interest rate may not be so helpful for the recovery of the real economy. So there may be some threshold. Some people call it a reversal rate that lower interest rate below the reversal rate is not really good for helping the economy and for the financial stability. So my question is there a tension between monetary policy and financial stability? And do you agree with those problems that some people point out in this time of the crisis?
Well, I'm happy to take a crack at it. I think it's useful to distinguish the sort of pre-crisis period and sort of now. You know, in the lead up, I think you can certainly say that low rates probably encouraged a buildup of financial leverage, you know, in the corporate sector and all of that. And I think that's made, to some extent, as we were just talking about, has made the problem a bit harder. You know, now we look at asset prices, as you said, Taka, you know, the stock market seems disturbingly high, perhaps. If you look at, for example, credit spreads on high yield bonds are, if anything, a little bit below their long run averages, and yet we're in the middle of a very dramatic recession. So, you know, across the board, asset prices seem high. I mean, my take currently is that, you know, some of this may well, of course, be, and some of the stock market may well be driven by low rates. I think what's maybe been even more impactful has been that the Fed, basically, what I was just talking about before, the Fed making these sort of dramatic announcements that, you know, the primary market and the secondary market facilities, effectively not low safe rates, but a willingness to intervene in credit in a way that's sort of different. And if you look, I mean, I've been doing this for some other work, if you look at kind of announcement effects, the things that have had the most dramatic effect for sure on credit spreads have been those sorts of announcements. The unveiling of the primary and secondary market facilities, some further announcements that were associated with revisions in the terms of those facilities, and so on. Those seem to have had the most dramatic effect. And there, I think, if you're worried about what you might call a bubble, I guess the worry would be, you know, the Fed has announced its policies, you know, or, you know, for example, you know, put out all these term sheets and so forth. You worry that investors might misperceive or over infer the extent to which the Fed is willing to kind of backstop credit markets. So again, it's very hard to understand if you look at the spreads on CCC rated bonds. And these are really kind of very risky bonds. Again, those are at levels that are really just very hard to reconcile with the default rates that we see on those bonds in any kind of recession, not to mention a severe recession. And it's as if, you know, my understanding of what the Fed has done is, you know, they might intervene to offset kind of technical disturbances in these markets. I don't think there's anything in what they've said or in what the law allows that would allow them to simply insulate investors from fundamental credit risk. In other words, the Fed is not going to buy defaulted bonds and is not going to make investors whole when those bonds default. And yet it's a little hard to understand the pricing, you know, without starting to think about that. So the bubble unwind that I guess I would worry about is less about just interest rates, you know, going up or exit. It's what if we get a further wave of downgrades and defaults? And at that point, we have to test the market's expectation that the Fed will do something about it. And I don't think they can really do anything about that kind of a fundamental development. And then you worry that there'll be, you know, sort of a big market disappointment. And I think that's carried over even to some extent to the equity market, because if you look at the early stages of the equity market rally, it was highly correlated with the credit market rally. So I think this is the whole idea of a Fed put and of maybe the market exaggerating the extent to which there's a Fed put, which is distinct from lower for longer, but which I think is, at least in this case, played a pretty significant role.
Yeah, so just pick up on that. I think I agree with what Jeremy just said. And the question is whether the Fed can in some way clarify their intentions. And I think that will be extremely difficult because you don't know what the next crisis will bring. Now, it is true that in order to activate the various things that Jeremy was talking about, they needed the approval of Secretary of Treasury. It had to be an unusual and exigent circumstances, et cetera. But I do think the market feels like this is now a tool that will be used more frequently in the future. And there's moral hazard and risk taking there, and how to deal with that is very difficult. But I think the Fed at some point here needs to turn its attention to whether it needs to change the terms on these particular things, to do a better job of clarifying the circumstances under which it will be used. This is would be a very risky thing for it to do, because people could say, oh, they're drawing back, and it could cause a problem. They would then have to intervene again. But I think you pointed out something very important. The other part of this, however, is the low for long is there to create jobs and to get inflation back to 2%. And giving up on that because of concerns about financial stability, you'd be giving up on the dual mandate of the Federal Reserve, or even the single mandate of the Bank of Japan or the Bank of England, getting inflation up to its target. And that's very costly too. So I do think it's up to the authorities and the people in universities behind them and think tanks to figure out financial stability tools that can address some of the low for long issues. And I talked a little bit about them. Is there something we can do about leverage in the non-bank sector, both among lenders and among borrowers? The corporate leverage was something that everybody was pointing to on the way into this crisis, even before the crisis. And the Fed kind of tried to do something about it and then got the props pulled out from under them by the General Accountability Office. But I think this calls for a general look at, are there tools that can be used to do something about leverage and liquidity management outside the banks? But I agree, Taka, it's a problem. And it's not, I think not only the low interest rates for a long time can encourage risk taking. People have nominal goals that they're trying to get to, but also the stability. So I worried in retrospect, if in 2004 and 5, the assurance by the Federal Reserve that we were going to do a quarter a month and only after a certain period, that we were giving more assurance than the underlying economy really dictated, and that removing that uncertainty was as important as the level of rates themselves. So how to make people aware that policy moves can't be assured forever, and the policymakers will respond to incoming developments that are themselves very unpredictable, would be an important part of addressing low for long issues.
I don't have much to add to Jeremy and Don, but since Japan has witnessed the longest decades of low for long, so maybe let me briefly report to you what we have seen. In spite of many people's expectation, we haven't seen bubbles in real estate markets. And in the United States, during the low for long period, corporate sector build on leverages. But in Japan, the non-financial corporate sector continued to repay the debt and accumulate revenue and accumulate cash at hand, reduce leverage. That's what happened during the low for long period. And many bankers report their lending margins are squeezed during the period. But maybe with the COVID, maybe we should be prepared to see even longer low flat yield curve. So whatever the effects of the policy, the regulators and bankers in Japan have to find ways to live with low for long environment. Thank you.
Thank you. May I ask a second question? This is a big regime question. You know, we know the history of the financial regulations, and Japan established FSA in 1998 in the midst of its own banking crisis in 1997 to 98. And many blamed the MOF, which was the financial regulator at that time. So they carved out part of the MOF to establish FSA. And some people looked at UK FSA as a model. And since then, Japan's FSA has proven that they are capable and they are competent and trustful, fair regulator. So I congratulate Himino-san that success of Japanese FSA. Now, in the UK, you know, it used to be part of the BOE, but they separated the supervision and monetary policy when they adopted the independent central bank in monetary policy. But in the crisis of 2007-8, that UK FSA was found to be incompetent, and they lacked the expertise and so on. So they put they brought back the supervision into the Bank of England, and they established the monetary policy wing and financial stability wing, and they are in the same roof, but somewhat independent. And in the US, maybe Jeremy can describe it better, but I would say it's very much fragmented and not much of the regime like Japan or UK. So if you draw on an ideal supervisory structure from scratch, you know, if you write on the whiteboard, what would be the best supervisory regime? Is it FSA type or central bank type, or still fragmented is the best? I know this is a big question, but.
I can talk to the UK experience. I'd be surprised if Jeremy answers that still fragmented is the best, but I'll wait for that. I think, and I would make a further differentiation, Taka, between micro and macro prudential authorities. So it's true that in the UK, both moved into, well, the macro was created. That's the committee I sit on, the Financial Policy Committee. There's also a macroprudential authority, also within the Bank of England, the Prudential Regulatory, PRA, Prudential Regulatory Authority. I think the central bank has to play a key role in the macroprudential policy. Does it have to be in charge? It's very unusual. My colleague at Brookings, Nellie Lang, tells me that the UK thing is very unusual. But I think the central bank brings lots of strengths to a macroprudential perspective. It's looking at the macro economy. It has economic experts and perspective about the macro economy. The central bank operates the lender of last resort that has to deal with financial crises. And I think that's part of what happened in the UK in the global financial crisis was there wasn't good cooperation between the FSA and the Bank of England on that. So from my perspective, thinking about the US, Jeremy, in the US, I worry that everyone looks to the Federal Reserve to preserve financial stability and it doesn't have the tools. So I do think somebody needs to have the tools for financial stability purposes, and the central bank needs to play a major role in that. Whether it needs to run it or not, I think is a more open question, but it needs to be very important. Thank you.
Just to pick up, so I agree basically with what everything that Don just said. And Taka, I also agree with the sort of characterization of the U.S. as I think was the word used, as a mess. So I agree with that. I just want to make, I guess I'm sort of quite pessimistic on this front. And I just want to point out that, you can have the best organizational design, and maybe that's necessary, but it's not sufficient. And I think some of the problems that we have in the US are not just problems of organizational design, or sometimes the organizational, the somewhat chaotic organizational design is endogenous to kind of deeper political economy problems. I think we are disadvantaged in ways that just the hand of any regulator in the US is in some ways a weaker hand than it is in some countries because of the political economy and environment. And if you want to just see that, think about cases where the central bank already has the authority. And yet, Don, you mentioned the importance and the value of the countercyclical capital buffer. Many, many countries raised their countercyclical capital buffer. The United States did not. If you look at the Basel III process, at the end of the Basel III process, we were left with a risk weighting system that did not put higher risk weights on high loan to value mortgages, which seemed like a pretty obvious thing to do. But, between the housing lobby and whatever other lobby, that somehow just didn't make its way to the final version of the regs. We have deployed other macroprudential, if you think about, would we be able to do time varying loan to value or time varying debt to income? I'm pessimistic, and it's not just because of where the authorities are lodged. So that's not to say that it's not important to have a more rational design. But again, I think some of what we're dealing with here is sort of a deeper and sort of quite thorny set of issues.
Well, thank you, Taka, for your nice words on JFSA. I'm not sure if the audience participating from Japan agree with Taka or not, but I would say there is no single right answer for organizational structure. If you put everything under single governor, from conduct and prudence to monetary policy and the payment system, that would be possibly beyond any human being's intellectual capability. But if you can synthesize everything, you can make the best quality judgment. And even if your structure is more fragmented, proper coordination would make it possible to do a high quality administration and decision making, and you can possibly ensure high expertise in the subject area. The US regulatory authorities play a very strong leadership in IOSCO, Basel Committee, IAIS or FSP, and commands a very high respect. So I think kind of structure divided into various organizations can have its own strengths. So I would say there is no right or wrong answer. Of course, if regulator make mistakes, you can reorganize it to show it get punished. But I'm not sure it would always result in a better quality of the decision making. Thank you.
So thank you all. We do have quite a number of questions, and I'm going to apologize in advance that we're certainly not going to get to all of them. But there are a couple of common themes across a few of them, so I'd like to pick a couple of them out while we still have some time left. Let me start with the topic that Himino-san mentioned during his prepared remarks, but we haven't talked too much about otherwise, but we got a couple kind of related questions about, you mentioned the impact of the liquidity episode on the considerations of too big to fail policies, resolution regimes, and so forth, and how thinking about liquidity under distress may cause and should cause some changes in resolution changes. So the question was, besides the report on repos and liquidity that you mentioned in June, are there other pieces of resolution policy that are potentially in conflict with what we think of as macroprudential crisis tools? Actually, this is a question for all three of you, this part of the question, that are worth reconsidering, because resolution policy looms pretty large in both liquidity and capital planning, obviously, as everybody knows, TLAC and liquidity requirements and so forth. So, but I'll start with Ryozo.
Thank you. My comment on the too big to fail is mainly related to the solvency phase. And I think the liquidity phase, at least in the banking sector, should be dealt with lender of the last resort function. Well, if it is about the non-bank sector, we need to think about the issue more deeply. And my personal view is we should work to prevent the recurrence of the buyer or the market maker of the last resort type of developments, as Jeremy has already mentioned. And my point on the potential need to utilize public backstop is more related to solvency phase. And firstly, this is not an endogenous crisis. It is an exogenous shock. And also, this is a kind of a systemic situation. And maybe the resolution tools we have developed so far might be able to deal with idiosyncratic failure of a certain size of institution. But you don't want to run the risk of making a big experiment in a systemic situation. And even if you succeed, bail-in or other resolution process could result in sudden credit crunch because many banks want to avoid the situation of hitting the regulatory minimum and being put under the resolution tools. So in this extraordinary environment, I think the ending too big to fail doctrine need to be handled with care. That's what I wanted to make in my point. Thank you.
I think a real challenge, the liquidity, the banks accumulated a lot of liquidity, partly for just safety reasons, but also importantly for LCR, for regulatory reasons. And those buffers are supposed also to be usable. But there's been a huge reluctance to use them. Now, maybe they haven't been tested yet because the economy slowed down and loan demand has slowed down after that initial surge. But I think a real challenge here is, are they usable? Do we want them to be used? And will the market allow them to be used? So what I've heard from banks is we don't want to be the guys that are the first people to break below the 100, the 100 LCR minimum, even if the regulators say it's okay, because liquidity is a foretaste, as Ryozo reminded us, of the coming solvency issues. So how to make those things more usable, I think, is a challenge. One thing that could be much better done in the United States is to integrate the lender of last resort to central bank facilities. There's a huge amount of stigma attached. There was an effort in the 2000s to get rid of the stigma, to make the discount rate a penalty rate, and there wasn't, you didn't have to get a call from the president of the Federal Reserve Bank in New York if you use the window. But I think in the crisis, no one wanted to use it because of the stigma. and the Fed itself not very open to the use. I think Randy Quarles, to his credit, before the COVID hit, started to talk and to work with the banks to make the discount window more usable. And I think that would be a good way to help the liquidity to pick that theme up, have it available in resolution and have it available pre-resolution so that banks had more flexibility in dealing with their liquidity issues.
Okay, great. So one last question. I know we're officially out of time. If the panelists are okay, we've got a lot of questions, so we'll take a few extra minutes, and those who can stay, we're happy to have you stay. The conversation about non-banks versus banks that all three of you alluded to, and thinking carefully about, but not just regulatory policy, but macroprudential policies. We had a question, this relates to the debate in the United States, but I think it's probably applicable in other countries as well, about doing activities-based macroprudential policies, so sort of across the financial system, regardless of who the entity is, versus entity-based regulations. I think this may be particularly pertinent for the cases that Jeremy was talking about in the corporate bond market, but it's also, all three of you mentioned the liquidity, the major liquidity issues in the non-bank sectors sort of around the globe, actually. And so the question is there a preference between those? Are those things doable in different countries? Because we have at least three different regimes here who can think about doing it.
Well, yeah, I mean, it's hard to argue. It's a sort of motherhood and apple pie thing. It's hard to argue against the principle of regulating like things similarly. And this goes back really to Taka's point. I mean, we have a system that just doesn't do that. So, I mean, to take a sort of, glaring example, think about money market mutual funds, which offer a product that's a lot like bank deposits. But which instead of being regulated as a bank is regulated by the SEC as as an investment vehicle. And that's been a problem, and we've recognized the problem, and there were all kinds of very, very sensible things in the spirit of activities-based regulation. Well, if it's sort of a deposit product, shouldn't it be like a bank with a little bit of capital? Maybe not so much because the assets aren't that risky. But people tried to think of it that way. And again, I don't know if it was the organization of the SEC and the FSOC, or it was the political economy, the sort of considerable lobbying power of the money market fund industry. But basically, we got money market fund reform that those of us who think about it in this activity-based way were not satisfied by. And we had some of the predictable, I mean, again, this was all, we've seen this movie now multiple times, and it was all a little bit predictable and unfortunate. So none of that is an argument against the principle. The principle is obviously right, but at least in our regulatory environments, the frustration of trying to move in that direction, even when, and that's a case where the analogy is very clear. Bond funds is a little bit trickier. It's a little bit less, has bank-like characteristics, but it's not as obviously bank-like as something where you can redeem, without breaking the buck, which is really very bank-like. So it's I think at some level, the question is not should we do it, but how, and this is to Ryozo's point, how in each of our individual jurisdictions where, one size doesn't fit all, how do we sort of approach that ideal as best we can?
Absolutely agree. It's how to implement it is the hard thing. And I worry that in the case of our FSOC, it's used that as a phrase, as a way of not doing anything, right? So they refuse to designate systemically important institutions, saying it should be activity oriented. Well, now what? So how are you dealing with that? We haven't heard the second part of that sentence. All we've heard is that we're not doing this, not what we are doing instead. So I think it's crucially important to put something concrete in its place, give some authority, FSOC, the Financial Policy Committee, the FSA in Japan or the Bank of Japan, the authority to look carefully at regulatory perimeters and see where they make recommendations to the legislature and the Congress to change them and make strong arguments that in order to implement this. So one example in the UK is payment systems. The Financial Policy Committee has set out three criteria or three ways of judging about a payment system, but and regulating them. One of them is that the regulation of payment systems should be end-to-end and depend on the whole system, the whole chain, and not focused on the individual entities in the chain. But that's a recommendation to Her Majesty's Treasury, who is now doing a study and will have to come up with legislation to implement that kind of activity, in this case payments, better than on an entity-by-entity basis.
I agree with Jeremy and Don, and what we should do is to do a proper post-mortem of the March event first, and as Jeremy said, identify the economic mechanism of the developments in March, and find out proper remedies for that. So the first task is not deciding about activity-based or entity-based. That would come at the end. And I would like to add that we have seen a problem in liquidity phase, but during the solvency phase, maybe non-bank sector might be able to pass on credit losses to ultimate investor better. And the banking sector might have a bigger propagation potentials. And during the recovery and the post-COVID growth phase, maybe we need more equities rather than debt. And that could come from non-bank sector rather than banking sector. So when we think about bank, non-bank issues, we should do March liquidity post-mortems, but also should think about following phases as well. Thank you.
Thank you. So really quickly, I'll set a hard stop at 9:15 then for us. And this is back to a point that all three of you made about political economy issues and how incredibly important they are in determining both regulatory structure and powers and authorities and so forth. But there's a lot of political turmoil all over the world right now. New prime minister in Japan, which is maybe the least tumultuous of the bunch. Given that turmoil, how do you navigate that to do the sorts of things that Don wants to do? Sorry, that Don and Jeremy and Himino, think we need to do, because you can't function without you can't do this stuff without having your governments and the authorities in place. But how does that? In what ways does that complicate things? And do you have thoughts about the right way to move forward?
I wouldn't call what's happening in Japan as a political turmoil. The prime minister got a health problem, and the ruling party is choosing his successor. It's an ordinary mechanism of democracy, not a turmoil at all. And you might see some kind of difficult developments in some part of the world, but political turmoil is an outcome of the various social economic changes, and the nation is trying to find the right direction through turmoil. So I wouldn't just deny the value of turmoil. Even turmoil could be a necessary process of transition into the new structure of the world. Thank you.
I don't know, you've raised a hugely important question, Trish. I'm not sure what the answer is. I guess my inclination is to try and figure out what the right stuff to do is, and tell people about it and sell it, as stabilizing the system and protecting people in the future from the sorts of things that have happened in the last 10, 12 years. And it's a very difficult problem. And one of the things I worry about is each time the parties in power change, they just do 180 degrees of what the previous folks did. And that's not a way. So I don't, I guess I just speaking personally, I just think we've got to push forward, do the analysis, try and convince people, hope there are enough people in the middle who are convincible and can see the power of our arguments of what needs to happen to make the system safer for the people globally, the people in our countries, but also globally in these interconnected markets. I don't know any other way to proceed in our think tanks and our universities is to just keep doing the right thing, but recognize the political environment. I know at Brookings, we have a project on financial stability, and one of our targets is congressional staff, and in both parties. And we're making an effort to try to appeal to at least the moderate influences on both sides of the aisle. I don't know any other way to do this.
Just the last thought. I mean, Trish, again, as Don, I mean, I don't have any solution. It's incredibly hard and important. Only that it intersects. I just want to mention that it sort of intersects with some of the questions that we were talking about before, about like how much regulatory scope and power do you want lodged in the Fed? And I always hesitate a little here because there are situations where I feel like in a kind of first best world, the Fed would be the right agency to handle such and such a thing. But then I worry that as you give it more power, you also make it more vulnerable to sort of changing political tides, to second guessing of various sorts that will ultimately compromise some of its core independence. You know, if what you're really, really concerned about is protecting its independence, let's say on monetary policy, if you give it more and more other responsibilities, that's just more opportunities for things to go wrong, for somebody to come after the institution generally. And so I just think that there's the tension between that question and the previous set of questions about, you know, where would you want this and that financial stability, responsibility launch. Just a way of saying this is very, very worrisome, I guess, if you're
Well, thank you all very, very much. Thank you to the three panelists. I really, really appreciate it. Thank you, Taka, my co-organizer. I also want to thank the SEPA events folks for putting this all together. Thank you, David Coughlin. And finally, thank you to the Center on Japanese Economy and Business at the Columbia Business School, who was our co-advertiser in putting this event together. We're very glad that so many of you joined us. And as I mentioned at the beginning, stay tuned. We will have a few more webinars this fall on central banking topics, and we'll make sure that you're all included in the invitations. Thank you, everybody. Have a great day.